if in the US companies within a group are treated as disregarded entities with a tick exercise, can a credit be applied? This was mentioned on the pre-recording, but I couldn't understand the impact for a US parent company and the disregarded entity. Okay, so in the US tax context, the term disregarded entity generally refers to a business entity that is not separate from its owner for income tax purposes. This means that the activities and financials of the disregarded entity are treated as directly undertaken by the owner itself. The most common type of disregarded entity is a single member LLC, a limited liability company, where the sole member is either an individual or a corporate entity. So when you refer to companies within a group being treated as disregarded entities with a tick exercise, it seems you might be referring to a check the box election. This is an IRS provision that allows an eligibility entity such as a foreign or domestic LLC to choose, in other words, check how it is classified for federal tax purposes as a corporation, partnership, or disregarded entity. So the impact on tax treatment. Since the disregarded entity is treated as a non-entity for federal income tax purposes, all of its assets, liabilities, income deductions, and credits are treated as belonging directly to the owner. This means that any business operations, expenses, or incomes of the disregarded entity are reported on the tax return of the parent company, just as if the activities were conducted directly by the parent. And then the parent company reports all the income and expenses of the disregarded entity on its own tax returns. This integration simplifies taxation, but also means that the parent assumes all tax responsibility. All right, and then regarding the tax credits, if the disregarded entity generates any tax credits, for instance, for research and development or renewable energy, etc., these credits can typically be claimed directly on the tax return of the US parent company. This is because for tax purposes, the activities generating these credits are considered as conducted by the parent company itself. And then making a check the box election to treat a foreign subsidiary as a disregarded entity can have significant tax implications, including how foreign taxes are paid by the subsidiary are treated. For example, the foreign income and taxes can be directly affected. The foreign income and taxes can directly affect the foreign tax credit as calculated on the US parent's tax return. And then in terms of strategic considerations, the decision to treat a foreign entity as disregarded can be motivated by tax efficiency, such as simplifying the US tax reporting requirements or optimizing foreign tax credits. It's crucial for the US parent to ensure compliance with all applicable US and foreign tax laws, which might involve complex calculations for income repatriation and credit. Okay, so I hope that clarifies that question.